the price target of $20 by the end of this year, representing 75% upside. Euronet's based in the US but has 3 businesses focused mainly on Europe. Mobile Top-Up is selling prepaid mobile minutes at kiosks. The business is structurally challenged by a shift from prepaid to postpaid and faces continued pricing pressure from lower mobile rates. Revenues declining and margins are high single digits. There's a turnaround story here based on prepaid content like iTunes credits, but I think this business is inherently challenged by a non-gifting culture in Europe and a shift from content downloads to paid and freemium subs. Money transfer is a remittance business like Western Union and MoneyGram. The business gives 2% price annually, so all the growth is driven by opening new locations, and there's some tailwind from a migrant workforce growth. The Street has this business growing mid-teens organically through 19, despite LTM growth of only 11%, down 800 basis points from a year ago. I don't have a strong near-term view on the money transfer business, but I believe it's structurally challenged in the long term by digital payments like PayPal and Venmo, and if you want to get spicy, by cryptos. ATMs. This business is mostly owning and operating machines in Eastern Europe. Euronet owns roughly 40% of its ATMs and operates 60% in conjunction with banks. Like-for-like transaction volume is shrinking about 2% a year, so unit growth is the key driver here, and Euronet has been pretty good at opening ATMs. Now, before getting into the pitch, I just want to point out that there's a strong argument to be made that all 3 of Euronet's businesses are terminally challenged by digital payments. None of them have pricing power, and volume declines should accelerate as we move up the digital adoption S-curve, which still hasn't really happened in most of Euronet's end markets to the extent that it's happened for this audience or even in the US more broadly. However, that's not the focus of this pitch. The focus of this pitch is on Euronet's ATM business and something called Dynamic Currency Conversion, or DCC, which is a service Euronet offers customers, mostly tourists, who want to see the conversion rate at the ATM and the equivalent amount withdrawn in their home currency as opposed to just the foreign currency. Management claims and the sell side believes that DCC fees represent 5 to 16% of total Euronet EBIT. I think that DCC is actually 50 to 70% of total Euronet EBIT. I also think European regulators are going to stop Euronet from overcharging on DCC in the next 6 to 12 months. DCC regulations will cut Euronet EBIT in half. That, combined with a derating, will result in Euronet losing 75% of its value. A nice corroborating red flag is that most of Euronet's executives are dumping stock in unplanned sales, and Euronet's CFO filed a Form 144 to sell all of his $14 million of stock in mid-December. Really quick on the setup, the Street has 7 buys and only 1 sell. One analyst downgraded in December on DCC risk, but then another analyst said potential regulation would have no impact for a couple years. Then, when the Alibaba MoneyGram deal was rejected and investors decided Euronet would buy MoneyGram, the stock quickly rebounded. Since then, the Street has only published on potential M&A synergies. Every single analyst is misquantifying DCC's margin contribution, and all but one analyst is completely ignoring regulatory risk. A lesser-known short activist put out a report on DCC 2 days ago, and I spoke to him. The stock was off 5%, but the report also underestimated DCC's margin contribution by a wide margin and lacked a lot of the evidence and analysis that I'll talk about today. Euronet stock's trading near its peak historical multiple, even after this short sell-off, 5%, of an aggressive consensus EPS that the Street has growing high single digits over the next, high teens over the next 2 years. Several analysts have argued for 20% EPS accretion by 2020 if Euronet buys MoneyGram. My bear case, upside downside, is 3.5 times the Street and 2 times an extreme bull case where the MoneyGram deal happens tomorrow and is 30% EPS accretive, a full year ahead of the management guidance given last spring before they bid for MoneyGram. Overall, I believe you could short Euronet with 2-to-1 upside downside. I'm going to walk through 3 key points. 1, Euronet is using DCC to charge predatory ATM fees. 2, those fees are responsible for 50 to 70% of total company profit. And 3, Euronet must stop charging these predatory fees. So just one more time on DCC. If you're traveling abroad, DCC lets you see the conversion rate and the equivalent amount you're withdrawing in your home currency. Without DCC, you just pull out 400 zloty if you're in Poland, and you're not told that's 100 euro. Sounds appealing, but that costs customers up to 5 times higher fees to see the exchange rate. Euronet DCC can charge 10 to 15 euro to take out 100 euro, representing 10 to 15% fees. They also pressure you into using DCC. The interface is specifically designed to scare you away from using bank conversion rates. They actually have a patent on how to get people to use DCC, which I found out earlier today talking to a former. I need to find that patent, otherwise I've put it on this page. Here's a quote from a former, how management used to brag about jacking DCC rates outside of strip clubs late at night when people had too much to drink and they couldn't figure out the exchange rate. Since Euronet never discloses DCC revenue in its financials, I looked at the impact that DCC had on the ATM business. Euronet started off offering DCC at scale in 2012. Since 11, revenue has more than doubled and adjusted EBITDA has more than tripled. Since DCC is mainly geared towards tourists and the third quarter is peak tourist season, I looked at Q3 seasonality and Q3 EBIT margin. It doubled from 11 to 13. It's clear that DCC has an outsized impact on the ATM business. Here I try to quantify the impact in 2 ways. Revenue per transaction was declining from 08 to 11 before DCC was implemented. Using incremental growth from 12 to 14 and applying a very conservative 85% incremental margin, keep in mind there's basically no marginal cost to Euronet associated with this service, I get to a 54% DCC contribution in 14. Using top-down analysis, making a few basic assumptions on 16 transactions, I get to a base case of 60% DCC contribution, which makes sense given the company admits on 2017 calls that the impact of DCC has been growing. To summarize, I estimate 50 to 70% of EBIT is from DCC. Now let's talk about why that's going to disappear. This is a quote from a sell-side analyst I spoke to who said that the CFO admitted to him that many ATMs would be unprofitable if rates were cut to 4% from 10 to 12% where they are today. Here are some of the key drivers behind DCC rates being reduced, including broad legislation to lower payment fees across Europe, consumer advocate groups lodging formal complaints against DCC and Euronet, and both the European Parliament and the European Commission adding DCC regulation to the agenda in the last few months. The Street's not talking about any of this. This is from the largest DCC service provider in the world. Sweeping payments legislation happened in Europe last month. It's called PSD2. It was supposed to make fees more competitive and protect the consumer. In case you didn't know, Western Europe's way ahead of the US in terms of digital payments and lower fees, except for Euronet. PSD2 went into effect and didn't impose any explicit regulations against DCC, but the language in it is all about transparency and consumer protection. PSD2 is in an editing period right now, which is important because several groups are trying very hard to add language about DCC. After various media outlets published damning reports on DCC in 2017, the EU Parliament issued a resolution in November calling for greater transparency and specifically targeting DCC. Here's some of the language in the EU Parliament resolution from last November. An industry consultant told me regulators want Euronet to show the implied fee and markup versus what your bank would charge. I think this is unlikely to happen because banks would have to disclose their rates, which is complicated for several reasons. I've been told that it's much more likely that the EC imposes a rate cap of 3 or 4%, which is more in line with the market and is what I model in my bear case. In terms of next steps, I think the Commission study could be released any day with a proposal to incorporate DCC language edits into PSD2 before June. I also think Euronet We'll probably have to address DCC on their Q4 earnings call next week. Here's risk reward.
All right, thank you very much.
The EFT segment is 40, the DCC business is within the EFT segment. The EFT segment is 47% of the company's EBIT. You're saying total company EBIT could be down if this DCC goes to 3 or 4%. Total company EBIT could be down 50, I think you said 50, 70, 80%.
That's right.
So that implies that EFT,
Running a
the
loss.
EFT segment excluding DCC would be negative. But prior to them launching DCC, the EFT segment was not negative. So
That's right.
why would it go from, why would it go negative with DCC reduced?
So if you look here, when I made the assumption that all incremental revenue per ATM transaction was attributable to DCC and then applied the margin and the math, you can see that it's declining low double digits in 10 and 11. That's a structural issue, and I think that continued. And I think what the company started to do was they started to open ATMs in very touristy areas that really had very few non-tourist users. And the way the unit economics work is, this is from quotes a few years ago when DCC was smaller, is that an ATM needs to make 3,000 transactions a month to break even, and that they make 5,000. I think that the tourist ATMs are making under 3,000, and they're only breaking even because of those fees. That's just based on.
Could you break down the revenue model of an ATM unit?
It depends. So for owned ATMs, it's roughly a 2% interchange fee, and then this DCC. And then for a bank partner unit, it's roughly 23 basis points of the transaction. I have a unit economics.
So for a bank, co-owned by the bank pays them 23 basis points per transaction.
That's correct.
Okay, and if they own it, where does the 2% come from?
The 2% is a standard interchange fee from owning the ATM.
From the debit network or the
That's
the
right.
account holder.
huh?
I think the account. When you go to a foreign ATM, usually.
And if these fees, DCC fees, go away, would they then revert to a more standardized pricing? In other words, have they substituted these DCC fees for the standard pricing, right? So if I'm a consumer, I see, oh, no fee ATM, so that's what drives me to it, but I end up paying these hidden DCC fees. So if the DCC goes away, then does part of that fee come back because they have to make money on the ATM?
So for the tourist transactions, if they opted out of DCC, they would pay a 2 to 3% fee, which the bank makes, because they apply some markup to the exchange rate, but really at the end of the day, and really whenever the transaction reaches its end destination. So I think that most likely, even if they outlaw DCC, they make no money. I think if they make they could justify a slight markup in exchange for showing their customer the rate, which provides some. They need some safety margin for doing it, for using a spot rate.
How much is their prepaid minutes business worth and their MoneyGram business worth?
That's
On an enterprise basis, because that's, the residual value is the 700 million of net cash on balance sheet, plus those two other segments.
Mm-hmm.
And that's your floor, because if they're losing money on DDC, it's only going to be 1 year, and then they're going to shut it down.
Yeah, so you could pitch this as a sum of the parts on how expensive it is, because, just go back. On a sum of the parts, the kiosk business is really, doesn't have a public comp. Here at the bottom left, you can see the multiples of where Cardtronics, Western Union, and MoneyGram trade.
So it's,
So-
call it 6 times EBIT. But what does that mean in terms of the $4 billion enterprise value? How much is it? How much are those two worth? The kiosk business and the MoneyGram business. It's about half the EBIT, right?
That's right.
Okay, so
I
those
think-
are worth, let's say, $2 billion, right? And you have 700 million. So your downside, and you lose because of the DDC, you lose all value in their stuff. So we lose $2 billion, basically.
First of all, I'm not sure that you could ascribe $2 billion to the two
The DD
orphan business or other businesses.
Another way to ask is what
Sorry.
multiple would you apply for the two other businesses if they were standalone businesses?
Yeah, again, for the money transfer business, I would probably apply wherever MG, wherever MoneyGram is, like 12 times.